Hello and welcome to today's 18 group on the fundamental review of the trading book, or Frtb as we know it, and indeed what still needs to be done before the global deadline of January 2023. My name is Sarah Underwood. I'm an editor here at 18 Group and I'll be moderating today's webinar. Our expert speakers today are Fausto Marceglia, Head of Product Management, Frtb and Regulatory at Refinitiv, an LSEG business, Marco Crotti, Policy Expert at the European Banking Authority, Santosh Fukula, Regulatory Reporting Oversight at Handelsbank, and Harry Farag, Senior Director, Head of Methodology and Analytics, Capital Markets Risk Management at CIBC. They'll all be introducing themselves in a minute, but first a little information to help you take part in the webinar. To the right of your video, you'll see a panel. It includes questions and answers and polls. We'll be running 3 polls today, so they will come up. So please feel free to vote. Always good to gauge your interest. And in the Q&A, please feel free to ask any questions to our speakers as we go along. We'll take them as we go along so that we don't leave them to the end and not have any time for questions. So please do feel free to ask the questions and I'll put as many as possible as I can to our speakers. So enough of me and let me come to the speakers indeed. Fausto, please introduce yourself and tell us a little bit about your interest in Frtb.
Thanks, Sarah, and welcome everyone. I'm Fausto Marceglia. I work in Refinitiv, which is part of the LSEG group, and I'm running product management for Frtb and a number of other regulatory propositions.
Thank you very much indeed. And Marco.
Hello, I'm Marco Crotti. I work for the European Banking Authority. I'm a policy expert in charge of Frtb topics. I mostly develop the regulatory technical standards under the IMA and the EU methodology for capitalizing the non-modelable risk factors. Yeah.
Excellent, thank you. And Santosh.
Hi all, welcome to 18 Group's webinar. I'm Santosh Sherkula. Have been working in prudential regulations for very long time, worked in Basel II space and subsequently embarked on Basel III journey, worked across banking and trading book. My expertise is in policy and interpretation and to come up with the subsequent solutions from change point of view. Thank you.
Excellent, thank you very much. And over to you, Hani.
Thank you. So Hani Farag, I head the modeling team for CIBC for market risk, trading and non-trading. And I have been working on the Frtb and in particular the internal models approach for quite a number of years now that we've come of age on the Frtb framework. Thank you.
Excellent. Thank you very much. All very much indeed. So let's get started and let's run first with an audience poll. The question is, how ready is your organization for Frtb compliance in 2023? So while you select your answer, let me come to Fausto to set the scene and talk a little bit about progress banks have made towards Frtb compliance. So over to you, Fausto.
Thanks, Sarah. So first of all, let me kick off by saying that we don't have at the moment, although the BCBS has set up a deadline, the implementation deadline for January 2023, it's up to the local jurisdiction to make sure that the rules are actually transformed, translated into legislation. And in this respect, banks are proceeding at different pace depending on jurisdiction which they are. So for example, as of today, I would say that EMEA has done by far most of the work in translating the rules and setting up the deadline. So EMEA has set up a deadline for the reporting requirements. Basically, it was last year, and for hard capital requirements, it will be 2025. And what we are seeing in EMEA in particular is that banks are now all set for the standardized approach, because the reporting deadline was last year, and now they are working. This is the year in which they are working on EMA and the internal models. And what they are doing as of today, they are basically finalizing the EMA business case. They are deciding which desks will go to EMA, which will remain to standardize it. They are making sure that they have a data vendor strategy engagement for the non-modelable risk factors for the RFET. And they are overall, they are preparing the material for making, let's say, the business case to ask the approval for the EMA desks to the relevant regulators. So let's say that between the end of this year and the beginning of next year, we expect that most of the banks that will have EMA desks in EMEA will do this application. In the rest of the world, the situation is a little bit fragmented because, the rules in many jurisdictions, the rules have not yet been translated into local legislation, and the timelines are fragmented as well. For example, in APAC, we are seeing that the first jurisdictions that will go live next year are Japan and Hong Kong, which are expected to go live, between March and July 2023. And most of the work is happening there specifically for the standardized approach, right? We expect most of the banks in APAC to go for the SA. In the US, the situation is a little bit different. So, if we exclude basically the global banks and the major regional banks, which are progressing well, similarly to EMEA, the rest of the banks are progressing, but I would say at a slower pace. So overall, I would conclude by saying that the status of the implementation is very, very fragmented across the jurisdictions.
Okay, lovely. Hani, what would you add there in terms of preparedness?
Yeah, so I would echo the same. I do see a spectrum among peers globally. Here in Canada, we're actually set to go live early 2024, so that is a set date, and we're proceeding, marching to that deadline on target. I will say that the internal models approach in particular is probably at the moment a smaller percentage of banks is working on that, and even the ones that are working on it also are a wide spectrum of where they are depending on their expectation. And I think depends also on as they implement, there are some quite interesting challenges as you start to work on that. Some you only discover, when you're closer to the end. I would say there is a bit of an 80-20 rule, where when you get to the last 20%, it opens up cans of worms, which you kind of felt might exist, but you didn't necessarily expect them fully. And so that's the spectrum I see, and I do think I'm not aware of any jurisdiction going live in early 2023, as far as I know, but I could stand to be corrected.
I think you're probably correct. As we planned this, we were looking at 2023, and then things began to recede away from us. So there we go. That's lovely. Thank you, Hani. And can we see the poll results, please? And Fausto, would you like to comment on these? So, good chunk there, pretty ready. What would you say?
Yeah, this is basically reflecting most of the work that specifically I think that most of the global banks and the large regional banks are actually doing. And the other factor here is that for the SA, most of the banks are actually already working. Have been working since time.
Okay, thank you very much indeed. So some good progress there indeed. Let's move on, and if I may, let me bring in Marco. Talked a little bit about the dateline and so on, but it's been delayed twice. There's more doubt, and 23 is not going to happen. Will there be another delay? How do you expect implementation and reporting timelines to pan out?
So yeah, indeed. I mean, it has been a long journey to design and implement the Frdb standards, and the journey is not yet completed. If you think that even when it comes to the output floor, we will be in the full regime only in 2028, it means that it took 20 years after the global financial crisis of 2008 to actually complete the reforms to let's say, adjust the drawbacks that led us also to the crisis. When it comes to the implementation of the Frtb in particular, I would like to say that first, in the EU, as Fausto said, we have already a reporting requirements, which is already in phase. And I think this is really important because it sets also legal certainty with all relevant stakeholders, in particular to banks that have to apply, of course, those rules. And when it comes to other jurisdictions, of course, I cannot say what they will do. But what I can say, of course, is that the EBA first has always sought for a timely and faithful implementation of the Frtb standards. So, of course, we don't consider as positive the fact that the Commission delayed the Frtb standards implementation in accordance with the proposal to 2025. But at the same time, as Fausto also mentioned, we are actually quite advanced with respect to other jurisdictions in the transposition of the standards into the legislation. So, at the end of the day, I think that it is good that the Commission put out the proposal. I think it is good that now the process at the co-legislator can start. And I think we really need to, at the EU level, but also across the various jurisdictions, to be faithful and to implement faithfully indeed the FRTB standards to avoid misinterpretation of the standard itself, but also a level playing field across the different jurisdictions that agree to the implementation of the Basel standards, let's say.
Okay, that's great. So it's been very bumpy road, but hopefully we better when it actually happens. Okay, Santosh, what would you to say to that? Obviously, you're out there as a user working away at it. What would you say to the timelines? And
yeah, sure. Just a disclaimer, the opinions what I'm going to discuss today are purely my personal, do not represent any one of my clients or previous or current employees. So in terms of the timelines, I broadly agree with the discussion points already, but there are mixed indications in the market. For example, if we look into ghost governors and heads of supervisions statement, which was released on the 9th of February, I think the Basel Committee clearly states that they're committed towards implementing all aspects of Basel III in a timely manner. So Basel Committee at a high-level framework design level wanted to implement all aspects of Basel III, including of FRTB in a timely manner. So that pushes towards the implementation timelines to be in 2023. But if we look into other statements, for example, a Dear CEO letter by PRA, which was released on the 12th of Jan 2022 for foreign banks in the UK, as well as another Dear CEO letter for UK deposit institutions, do not specify that FRTB or trading book regulations are a primary objective of PRA in 2022. Rather, both of the Dear CEO letters highlight on climate risk, operational resilience, regulatory reporting, so on and so forth. So there are mixed views in the market, but at the same time, PRA also started engaging many banks on SA. So I would think it will be still 2023 in UK, but I think it will be a phased approach. I think it can be SA to begin with, and then subsequently move to IMA. And from US point of view, again, we haven't heard anything on US notice for proposed rules yet. But if we look into the history during Basel II implementation, the implementation was done in a categorization manner. Initially, it was applied for the big banks, then subsequently to the smaller banks. Hence, I would think US may take the same approach. FRTB guidelines may be applicable to the bigger banks first, and then subsequently to the smaller banks. And in recent past, even PRA is also taking similar approach that has been observed in UK leverage ratio. The regime is not applicable to all banks in the UK to start with, but it is based upon banks' balance sheet size. Hence, I would think, in summary, I think it's going to be phased approach. It can start with SA and end with IMA, and to, of course, roll out to capital flows, as well as I think the size of the bank matters, whether the rules are going to be applicable from Jan 2023 or not. And geopolitical developments also should be looked very carefully in terms of overall economy, whether there will be a short credit supply, so on and so forth for supervisors to take the decision on.
okay, thank you. Yes, it's complicated, and we'll come back to jurisdictions and different regulations a bit later on in the webinar. But meantime, let's run another poll, if we may. This one asks, which elements of FRTB are currently the most challenging at your organization? And this time you can tick as many boxes as are appropriate to your organization. So while you do that, let me come back to Fausto to talk about which elements of these FRTB requirements he sees as still a challenge.
Look, at the end of the day, the overall framework for FRTB is much more complex, compared to the previous regime, right? And if I look, what the level of feedback that I'm receiving, we are receiving from customers, right? There are, recurring themes that we keep discussing. One of them is about the SA, the standardized approach, which is now, much more complex because it is driven by risk sensitivities, right? And this would require, at a certain point to map those risk sensitivities to regulatory buckets. And again, the challenge here is that for doing this mapping, you need to have an inventory of T's and C's terms and conditions, let's say data fields for the relevant, trading positions, which is up to date and which is, clearly qualitative. And this at the end of the day would require to get this inventories in place and ask the help of external vendors for filling all the gaps that you might have. The other challenges around the SA are around let's say the so-called look-through requirements, which require basically banks to decompose trading positions, which refer to indices and to funds into the individual constituents, right? Which again would require help from vendors. Moving to internal models, the biggest challenge that we see, the two biggest challenges that we see is, first of all, internal models, again, is much more complex. There are multiple types of quantitative and qualitative tests that have to be done. And this would require, in order to connect different aspects of the enterprise, this requires an effort for modernizing the data infrastructure, which is one of the biggest challenges that we see in the market. I was talking a couple of weeks ago to a customer in the US, and he was telling me that at the moment they will go live just for the SA. They are not even evaluating the internal models because at the moment they don't have even the skills, the expertise, and also the investments for running the internal models. This will be evaluated at a later stage. And the other challenge that we see on internal model is about it's not a surprise. It's about the RFET, the risk factor eligibility test. This is a big challenge for the market, therefore, for those desks that we go to EMA for multiple reasons. First of all, because, most of the trading positions are basically related, to OTC, illiquid products, which require data that is not public, which require trade data that is not public. Secondly, there are methodological issues for mapping, these real price observations, to the risk factors, which some of them are still on the table. And finally, I would mention also an element of uncertainty in the rules. So for example, there are rules at the moment which are impacting the RFET, which are divergent between the local, let's say, the local interpretation, for example, of Europe. Europe published in June 2020, basically an RTS on which they were defining multiple aspects around the RFET. And one of them was about the definition of a committed quote. As an example, this definition of a committed quote is basically divergent from what we are seeing in the BCBSX. So the bottom line is that these are elements of uncertainty that are preventing banks to use this particular feature. And what we would like to see here is a kind of harmonization effort across all the different jurisdictions to make sure that we don't have divergence, because divergence is a source of overcomplication and at the end of the day, source of additional costs.
Okay, as I said, we'll come back to that and try and sort a bit of that out later. But Marco, coming to you, what does the EBA see as the chief challenges here?
No, indeed. Let me, endorse what Fausto says. Every said with respect to the challenges ahead, meaning the one related to the funds and the look-through approach, and also the one related to the RFET, of course, and not relatively to the RTS, but more, let's say, on the challenges that banks may have in general in meeting the RFET requirements that are present in the Frtb standards. Let me say also that with respect to funds, what we see is that banks do not have just difficulties with respect to the look-through approach, but also with the other approach that is present in the SA to compute, let's say, the capital requirements related to a fund using a sort of hypothetical portfolio that should respect some feature of the fund. But apparently many banks consider this as not practical, let's say. And as you may have seen in the Commission proposal, the EBA also received a mandate to further support banks in interpreting even the Frtb standards with respect to the requirements of fund in the building of the hypothetical portfolio. Furthermore, I think there are other two challenges ahead for IMA banks mostly. First, I think that many banks are currently trying also to decide actually how to represent their risks, meaning what are actually the risk factors that they decide to include in their models, in a way also maximizing the number of risk factors falling or better passing the RFET, and so to minimize those that are considered non-modelable. So indeed, the RFET is a very important test in this regard. And second, I think another component relates to the timeline. Indeed, despite, as I said before, the EU with the Commission proposal pushed the timeline to 2025, for IMA banks, they need to get the approval first, which it's a process in itself. And second, banks need also to approach the supervisor with a 1-year P&L and 1-year results of backtesting and profit and loss attribution test results. So at the end of the day, before even approaching the supervisors, the bank needs to have done a lot of work in advance. So regardless of the push of the timeline, I think the timeline still looks very tight. So I think these are the main challenges that banks will now face.
Okay, thank you very much indeed. And let's see how our audience is feeling about the challenges they face. And Marco, would you like to comment on these results? NFRs, where's the threat? Oh, they're up, the risk factors coming down quite low there. So Marco, what would you say there?
So indeed, I would have expected the RFF to be at a more high level. So I expect that on MRFs in general, at least in the EU, we have a methodology which is quite prescriptive. So at the end of the day, we expect banks not to face particular difficulties in implementing the methodology itself, although it can be sometimes computationally burdensome, let's say, but it is quite obvious, let's say, how banks are to build it. But so yeah, I find this quite surprising. I didn't expect the RFF to be at the bottom of these surveys, to be honest.
Okay, perhaps we're looking at people who are doing very well.
Yeah.
And they're here because they're doing very well, but they want to do even a little bit better. Excellent. Thank you for that. And let me come back to you, Hani, to talk a little bit about how banks are resolving all these challenges that have been mentioned and dealing with the data sourcing and data management issues and how these issues can be addressed.
Sure. So I would echo Marco's comments, but I would say this. So I mean, you feel the timelines in 2025 are tight. You should see our early 2024 timelines. That is a different order of magnitude of challenges, particularly for the internal models approach, although there are some overlaps. So I'm going to try to quickly give a point. So one of the items that I didn't see on this poll is the NMRF research itself. Some of it is very difficult. So some it's kind of known how you decompose, whatever, but some allowances in the regulations are quite non-trivial. And if you want to make it viable and have a reasonable capital impact, it actually takes a fair bit of time. So if there's any shared advice I can give is to start that as early as possible, well in advance. It's not the kind of thing you do last minute and you try to scale it up at the end. It won't work that way, particularly in what the so-called idiosyncratic decompositions or idiosyncratic risk factors, because they have a different treatment and is very favorable. But in order to justify all the requirements, it is highly non-trivial. In terms of, so PLA, as mentioned, so PLA forces you to typically, for most banks, to choose new risk factors, as Marco said. Those new risk factors will also force data requirements, which you may not have today in your bank. So suddenly you need data, historical data, to build your time series, particularly for most banks that are on historical, or even if you have other types of models, but you still need historical data. That now suddenly becomes a new requirement, a new challenge, and you may or may not have all the data you need. And obviously you try to go to vendors so they can help to some degree, but in other cases you may, given what your front office might be doing with their own markings, and because of PLA, you have to align to what the front office does, and therefore suddenly now you may have to go and build some of your market data constructions using instruments. And so in some cases you have to start from scratch, and if you don't, then suddenly your PLA may not work as well. Like you have to align your risk factors, and that forces the data requirement by implication. Risk factor eligibility test, I think you have to see it when you get there. And maybe if you're a very large bank and you can have all the data internally, it might be less problematic. But I think when you actually dig down into this, even if you're an active bank, you may not be active on everything. And so we do find, even when data is available publicly, RFETs turn out to represent challenges because you don't have all the data in one place, and it's not all streamlined or normalized to use it. So yes, you do need to look at vendors for these types of products, but you may also have to aggregate internal data But aggregating internal data is also non-trivial if you're not already doing it, and you're not already doing it for a similar purpose. Suddenly you have an extra implementation you didn't plan for. So you don't expect this until you do it with your own hands. As to maybe the fourth point, which I also would say is fairly challenging, is this funds look-through mentioned by Marco as well. So the funds look-through, and yes, the capital impact by the so-called hypothetical portfolio or mandate approach, it still is nowhere near the efficiency you would like to have. And if you can get, it's not just data, however. So the data itself is a bit of a challenge to get funds. Some funds don't disclose all their holdings, but even if you do have that, you suddenly have a fund that in the past we used to treat conservatively as, we call it the widget approach, but it really like an equity, which the FRTB also allows you to do, but it's an expensive approach. If you want to put it in the model in any meaningful way, now you have to, suddenly this fund may break up into 1,000 holdings. And so your system has to account for what looks like 1,000 positions, and you may have derivatives on top of this. So I think these are the areas I would say are challenging, and you should plan early to resolve them if you're intending to work on the internal models approach. But even the standardized approach will require this funds look through to have any capital efficiency on these products. I'll stop here.
Thank you. Fausto, there's a lot of moving parts. Would you like to pick out a couple which you see as particularly difficult?
Yeah, absolutely. And in particular, I totally agree with with what Annie was saying. And in particular, I'd like to elaborate, on his statement about, basically taking data, sourcing data from external vendor is important, but there are also other challenges which are related, to manage, this big amount of data. And let me elaborate around the RFET in particular, right? So for the RFET, the overall purpose of the RFET is to make sure that, the number of non-modelable risk factors is actually minimum, because the bigger is that number, the more the capital charges, will grow, because the non-modelable risk factors will basically, charge it, at a much more punitive methodology, which is the stressed expected shortfall. So there is a strong interest from a bank perspective to minimize these non-modelable risk factors. How they can do that? Clearly, the first resource, as Annie was saying, would be the internal trades, right? So the first thing that banks should look at are their internal trading activity. However, extracting trades from many different siloed applications is not an easy task, because again, this would require data management infrastructure which are in some way modernized and able to manage this task, which is not easy at all. And secondly, this is about mapping all data coming with different formats, coming from different applications to a consistent data model, which is again is not an easy task. So even before deciding which data you need, you need to make an assessment internally about where exactly are the gaps. And then once that you have got an idea about the gaps in terms of data that you have to source, then you have to have this data management strategy in place for working with external vendors. And in this respect, I feel that the external vendors will play a critical role here, because they can help really to fill the gaps in many different asset classes for which, specifically not OTC data, for which we see that there is, a general lack of, trades and quotes for passing this NMRF.
Yep. Absolutely. Thank you very much for that, both of you. Just some of the complexity, very well explained. Thank you very much indeed. Let's take a quick break, if we may, for some audience questions. Marco, I have one here that I'm not sure I entirely understand, but let me put it to you and see if you understand it. And if not, we can put it to one side and look at it offline. So here we go, Marco. The CRR seems to balance the requirements of FRTB against the incremental capital demand to avoid disproportional capital demands, including a scaling factor. On the other hand, the EBA RTSs seem to take an extreme take on the Basel requirements, e.g. on bid-ask quotes and MRFs. Is there a disconnect here? That's a very big question.
No, I don't think it is the case. So I think we need to consider first that the EU is made by 27 states. So of course, for us, it is even more important to ensure harmonization in the single market. Second of all, I think that with respect to the NMRF in particular, we believe as EBA that the FRTB standards are not prescriptive enough. and it is not even in the interest of banks to actually have such a high level requirements with respect to the way that banks need to, how do you say, implement the way that banks need to implement basically the NMLF and the SSRM charge, let's say. Why so? Because when you don't set any expectation with respect also to the dialogue that banks will have here with their supervisors in particular. So if I get 10 IMA banks applying for the internal model approach, they have the same exposure and they get 10 different capital requirements, and they differ significantly, then there is a problem even of competition, which is not just actually at the EU level, but is actually at global level. So yeah, I don't think that there is a disconnection, to be honest.
Okay, thank you for that. And Fausto, may I come back to you with one? You talked about outsourcing data, third-party data, and this question asks quite bluntly, what is the panel's view on outsourcing some parts of FRTB? You talked about some of the data. Are there other functions that can be done on an outsourced basis?
Yeah, we are seeing that there are multiple vendors that are offering, first of all, a software solution for certain parts of FRTB, for example, for the SBM calculation for the standardized approach, right? As well as for the RFET, there are solutions for calculating, the pass or fail flag for the MRF. And also, there are many market risk vendors that are providing end-to-end solution for the overall, let's say, implementation of the framework here. So in this respect, there are several aspects that can be actually, outsourced in this respect, using data or, more importantly, systems from external vendors.
Okay, fine. Henny, one for you. This is quite a big, wide one. And it says, what impact does the panel expect to see across banks when FRTB goes live?
Sorry, can you repeat that? What impact on capital?
Yeah, no. What impact does the panel expect to see across banks when FRTB goes live? What are the knock-ons going to be?
Oh, okay. So I think that banks that invest, so just for disclosure, I'm not entirely clear on if there is some prescriptions in the EU for some of the NMRF treatment. I want to be cautious not to overstep. But in my view, generally under Basel rules as they stand, I think if you invest heavily in your modeling, I'm inclined to believe that you are likely not to be impacted negatively on capital, provided you solve the problems we listed before, which I recognize, they're not easy and they take a long time to work on. So I would. That is my prediction, is that, if anything, it will be marginally up, could be marginally down. So I think it's a positive impact in that sense. I do think, however, the other impact I would predict is that over time, so not in the early stages, over time, as it gets easier and people look at each other, probably internal models will be more prevalent than we think it will be on day one. And finally, I think the one other impact, and might be slightly negative, although from a risk capital calculation or measurement, maybe the FRTB does improve many things, it probably will get more complex, that it will be harder for people to explain it on a daily basis, for example, to the traders and other areas in the business. These would be my predictions for it.
Okay, thank you. Very positive. Thank you very much indeed. And Santosh, coming to you again as a practitioner, how can we try to manage the costs of FRTB? It is expensive. Can you give us some ideas there? Oh, I'm not sure Santosh is still with us. Oh no, Santosh is gone. Does anybody else want to pick that one up briefly? How can we manage cost? Oh, Santosh's back. Santosh, how can we manage the cost of FRTB? No problem.
Well, I think in terms of managing the cost of FRTB, I think one of the key points is to outsource. That can be in terms of model validation, model development, or regulatory reporting. That's one of the key areas. And the second thing is to utilize cross-functional change projects. One example is OFIT itself, like as we know, in terms of volatility surface construction, many many banks are investing heavily in terms of getting the right data that can be potentially used for OFET. So I think we need to look from the lens of both optimizing across cross-functional change projects, as well as to identify areas which can be outsourced.
Okay, great. Thank you very much indeed. That will ease some tension in the bank then if you can outsource a fair bit. Excellent. Thank you. Thank you all for your questions. Thank you to our speakers for taking them on. And let's get back to my questions and coming back to you, Santosh. How can banks within the scope of FRTB address the additional complexities caused by different interpretations of the regulation and implementation timelines in different jurisdictions? Now, we've talked about how unadvantageous this is. How are people going to cope, big banks with in lots of different jurisdictions, and indeed small banks in different jurisdictions? How can this begin to be resolved?
Yeah, so the obvious, sure. So I think there's a predefined regulatory process in many banks to start with identifying the jurisdictional differences and to subsequently socialize the differences with front office with the impact on the books and the capital, as well as to socialize the impacts and the variations with the CROs and CFOs. Hence, like I think the answer is to be very clear about jurisdictional differences in place first, and then to also subsequently have calculators working in multiple jurisdictions with various jurisdictional variations to accommodate EBA versus Basel differences, so on and so forth. So, for example, once PRA comes up with its BTSs, binding technical statements, then the banks can easily switch between EBA guidelines or BCBS guidelines based upon what the BTSs say.
Okay, that's great. Marco, you mentioned this earlier. What do you think? How should people approach this? It is always difficult with every regulation, but FRTB is very complex.
Yeah, indeed. So we think that it is very important, of course, to create dialogue with the relevant supervisor, with the relevant competent authorities. And of course, after that, the dialogue even among supervisor will kick in. And what I would like to stress is that, of course, we have some tools among ourselves to bring clarity on the regulation and the standards, meaning the Basel FAQ tool, but also the EBA Q&A tool. On top of it, as regulator, of course, we try to ensure consistency in the application of the regulation. As part of the exercises that we run in a more structured manner, we have the EBA benchmarking exercise. This exercise, I believe, will become even more important to backtest even the regulation. So when the Frtb will kick in, we'll actually assess on the same portfolio what all banks in the EU that have the IMA approval do. And so at that point, we will also be able to assess, even under the standardized approach, even if they are IMA banks, what they do. And so at that point, also to assess the regulation, is the same requirement applied consistently across banks? And if not, what should we do? So this is an exercise that we plan to do in the future, of course.
Okay, thank you. Thanks for that, both.
Sarah, may I interject?
Yes, honey, go ahead.
Make a point on this. I hope that's constructive for everyone. So just maybe from a practitioner's point of view, I'd like to express my personal opinion, not that of my employer. So I do believe that the regulators, they stated the purpose of the standardized approach versus the internal models approach, so that you have a floor, capital floor, and you have bounds, so that the variation on RWAs is constrained, so that, as Mark was saying, different banks so they cannot deviate dramatically on RWAs. I think, however, in my view, it would not be right that if we end up being so prescriptive on the modeling approach, that we may as well turn it back into another standardized approach. There would be no incentive for banks to work hard on efficient modeling, getting the better data, investing in modeling the risk more efficiently, and have a capital benefit as exactly as the regulation is kind of stating the purpose and allowing and incentivizing. I just wanted to express that as a personal opinion from all the years I spent on the FRTB. If we roll this back to what looks like another standardized approach, I don't think that's beneficial to the industry or the purpose of the regulation. And again, this is my personal opinion. So I'll leave it at that.
Okay, thank you. I think that's a very interesting point, and we are trying to move forward after all. And let's move on a bit now and look at some of the practicalities. And Fausto, please tell us a little bit about what RegTech tools, services, and solutions can be helpful. You talked about systems earlier. are there any recommendations here, not in terms of particular companies, obviously, but anything that people can be useful?
As I touched, before, there are multiple solutions available today in the market for helping banks to comply with the overall FRTB framework. There are data management and market risk, let's say, data vendors that are actually, offering solutions for implementing the overall framework. And from a data perspective, there are also multiple vendors that are offering data specifically for DSA as well as for the RFET. And those solutions, perhaps I can touch base on, different nuances of the solutions provided by the vendors, by data vendors, because this is closer, to my experience. I see that, there are different solutions based on the output. There are solutions that are actually providing, RPOs, real price observation, raw data around the real price observations at instrument level. And there are solutions that are providing basically pass or fail flags for the risk factors, which means that they embed some level of, instruments to risk factor mapping. There are even differences in terms of the data sources. There are solutions that are taking data, from banks directly, so they're accepting contribution directly from the banks. And there are solutions that are basically taking, sourcing data from independent market infrastructure providers. So basically, there is, quite a big, let's say, set of, different solutions that are available even on the data aspect. So it's up to the bank in terms of, the strategy that they want to have in place for implementing this to decide. However, clearly, getting, let's say, data, raw data, and getting, let's say, data for the RPOs, for the RFET, basically gives in general more flexibility to the bank, because banks are then free to implement, their methodology for mapping, those RPOs to the risk factors, right? That's in general what we are seeing. But again, it's really up to the strategy that the bank has got for the RFET.
Okay. And Santosh, as somebody who's actually sort of doing this hands-on, what have you found useful?
Offit and RPOs are definitely an area where you can use technology and observations from third-party vendors. Besides that, ability to drill down capital to desk level and the sensitivities is another key area where many banks can utilize various technology tools. So because like FRTB ideally puts back the responsibility to the desk supervisors or desk sets for capital management. Hence, it's not viewing a number at a whole bank level, but you have to have the right toolkits to drill down to the desk level and to the book level and to the underlying trade level as well.
Okay, thank you very much. And Santosh, staying with you, with so much to do and so much complexity, what steps should banks be taking now to get over their FRTB compliance date, which may be in 2023 or some part of it? And do you expect to see any regulatory leniency, or after this long, that's not going to happen?
Well, I think in terms of standardized approach, at least the PRA anyway started engaging many banks, so the calculators are in place. So I think the next step forward is in terms of integrating FRTB calculators in the overall regulatory reporting framework, governance, and so on and so forth. So I think banks should start socializing the policies around FRTB, as well as banks should start putting right governance structure in place in case if the numbers go up and down, and if the numbers do have a lot of variations, how do they deal it with, and subsequently start integrating with overall regulatory reporting. So in terms of SA, it's simpler, but still a lot to do. But in terms of IMA, I think the biggest challenge is the application process itself. IMA applications isn't that easier, hence like banks have to do a lot of back testing, so on and so forth.
Okay. Fausto, what would you say are next steps here?
I would say that basically for banks that are planning, to have desks on EMA, or at least that they are, thinking of having trading desks on EMA, I think that they should assess as soon as possible, if not already done, how good is their data management infrastructure for connecting the different, parts of the enterprise, so the front, middle office, to make sure that they are able to source, the data and to flow the data between the different, applications in a way that is, possibly manageable. And the second thing about IMA, I would say that it's critical that, they start to have a data vendor engagement strategy in place, and they start to test the data from vendors once that they have identified, which specific asset classes they require for filling the gaps for the RFET. And the last thing that I would say is on the regulatory side, it's not about linearity, right? But it's about making sure that there is this concern today in the industry that it's a kind of level playing field concern, because some jurisdictions are basically progressing at a different pace than others, right? So clearly there is a level playing field concern. I think that from a regulatory perspective, the industry is actually expecting to have a kind of harmonization effort. So to make sure that, if not on the timelines, but at least on the rules, we have, let's say, rules which are more or less consistent across the board, so that we don't have divergences. We are starting to see, as I said before, we are starting to see some elements of divergence in the rules, but it's critical that this is actually managed, and we have this harmonization of the rules across the board. This is critical, because otherwise what we will end up with, it will be basically adding much more complexity and much more costs, specifically for the IMA implementation.
Okay, that's great. So as you say, some fundamentals and then some more complex aspects on top of that. Okay, we don't have a lot of time, but we have some more questions, and I'd like to squeeze in another couple. And Fausto, the first one to you. One of the hardest challenges is to find data regarding delta bucketing and strike price values because of sensitivity of the strike price levels. What are the banks and vendors' approach in this space for NMRF? Do you see this as a major blocker?
For sure, we are seeing that this is a requirement, with all the banks that typically we are talking with, specifically those that have to assess the volatilities, right? So, having the strike, for the delta buckets and so on, this is a critical requirement for sure. I think this is something that can be addressable. Don't see this as something that can be a big issue, to be honest. It's something that we are already addressing in not only Refinitiv but other vendors as well. So it's something that can be addressable for sure, if that is the question.
Okay, it is. Thank you. And Marco, can I come back to you with another one? It says there still seems to be ambiguity whether a mere observation counting without actual deal data is possible for the RFET. Given some vendor offering becoming non-viable if prices are required, is there a clear line? I think this is something that we've been talking about for a very long time.
Sorry, can you repeat the last part of the question? I couldn't get it.
Sure. Given some vendor offerings, could they become non-viable if prices are required? Is there a clear line, I guess, on what you can see and what you can't?
No, indeed. I think as also Fausto was mentioning before, I think there are different solutions. I think from data vendors, I'm not very familiar with them as a regulator, to be honest. But what I know for sure is that banks need to know of course, the number of observation that can be considered as a real price observation. But on top of it, we also would like to have banks be able also to see some of those real price observation, because at the end of the day, we think that real price observation are somewhat the golden data with respect to data quality. And so at that point, we would also like to see, for example, at least I think that banks that have access to some transactions, at least, will be able also to justify the level of volatility that they assume, for example, in the internal model approach. So it is true that sometimes you don't need to know the actual price, but on the other hand, knowing it may put you in an advantage when justifying some assumptions that you have made in your internal model, I would say.
Okay, thank you very much. And Hani, a quick one for you. It's more of a statement than a question, but let me know if you agree or not. And it says, I'm surprised there is no mention of the challenges of implementing the expected shortfall approach to replace VAR. Is that a challenge?
There are some computational challenges, but it's not otherwise too much of a challenge. So just to clarify, because expected shortfall requires different varieties of it, one in which all risk factors are aggregated, one in which different horizons are applied, and some you take the different asset classes and you sum them. So it's a heavier computational burden. Frankly, it's not otherwise that complicated. Having said that, I will share some of the challenges we see that require more effort. When you change risk factors, sometimes to align more with the front office, you also start to see pricing failures sometimes. So now you have to deal with what happens when the pricer can't price a specific shock that you had to model, which maybe today you don't have to model. it's a challenge, but it's a good thing to have because now you understand your risk, I would say, with a higher degree of accuracy. I think the cloud also opens up, as long as you take care of security aspects, that it is possible to do more calculations. So I think, yes, it is a challenge, but compared to all the things we've been mentioning, we find this one to be less of a challenge.
Okay, I hope whoever asked the question finds that to be the case too over time. So thank you very much indeed for your questions and answers again. And we're running down on time, but let's just run a last audience poll if we may. And the question is, what are or would you expect to be the benefits of a strategic approach to FRTB at your organization? So pick as many answers as you like, whilst I come to Hani to ask him how he sees the benefits beyond compliance of getting FRTB right, and perhaps what are the penalties of getting it wrong? Yeah,
so I believe that market efficiency will continue to increase. Today banks compete with lots of other types of organizations that are trying to enter the financial markets. So I don't think there's any simple way of making good investment, good return on capital, unless you're efficient, unless you don't leave out little bits and pieces that you can improve in your organization, and you improve your risk measurements, you improve your your capital consumption. And I think the regulators recognize that. So I think if you don't do any of this, you can easily lose some business. I think there are areas where if you don't do the IMA, you probably will have very high cost of capital, and maybe some businesses will not be viable. So to me, it is an opportunity to improve your risk management, improve the capital measures, which is the purpose of the regulations. I recognize that there will be a challenge in explaining all the bits to internal stakeholders, but I do think it's a positive. Among all the things we improve and we evolve on in technology, why wouldn't risk management get some of that evolution as well? So in my view, I think that's the way to go.
Okay, I'm going to move on here and let's see the poll result if we may. Let's see how our audience see the results. Okay, Hani, there you go. Would you like to make a quick comment on these results? These things have been mentioned throughout the webinar.
Yeah, so I think I would just comment that the greater transparency is a mixed bag. Yes, you get greater transparency of all the data issues that were just described by other colleagues here. I think that is fair and absolutely true. You improve many of those things. You also understand your risk a lot more because you're much closer to what the front office is doing for their own trades. You also modernize your system. I think the greater transparency is a little bit tricky, as I said, in explaining the steps to an internal audience that is not a technical expert. That I don't know if it will actually materialize. But anyway, I think I agree with all of these by and large. It's just that the transparency is a mixed bag in my view.
Excellent. Thank you very much indeed. And we are coming close to the end of time. So finally, let me ask our speakers what advice they would offer to practitioners working on FRTB implementation and compliance. So Marco, perhaps you'd kick off here.
Yeah, I'd say definitely good data management. Then also invest on processes. I think sometimes they are not, how do you say, well-represented processes and good governance, in particular with respect to things that are particularly complex. And then also, as I said before, approach the supervisors on time. We are on the same boat with respect to this project. So at the end of the day, I think that the dialogue with the relevant competent authority is also a key asset and something important to implement. Yeah.
Thank you, Santosh.
Well, I think the key takeaways are pretty much integrating FRTB siloed projects into wider regulatory oversight and reporting. That is integrating FRTB projects with the reporting frameworks and to provide the capital numbers back to the desks. And second point is making the desks aware of the FRTB rules, because like FRTB is going to shift the way regulatory engagement is going to work on. Supervisors may directly end up speaking to desks, hence the desks have to be more clearer on the rules. capital adequacy rules, like in this case, Frtb. The third point is to leverage out across various strategic projects that are already in place that can be improvising front office market data to build better pricing inputs, including volatility surfaces, or to provide better transparency in terms of reporting.
Thank you. Hani, a few words from you.
I don't really have anything additional to add to this, to be honest. So I don't want to just clutter the presentation. Thank you.
Okay, so Fausto, some last words from you, unless you are in conjunction with everybody else.
For sure, I'm in agreement with whatever has been said. I just would add, quickly three things. So if you have not started to work on Frtb, and especially if you have desks that will go to EMA, start to work now, because it will take a lot of time. Secondly, take this as an opportunity for modernizing the data management infrastructure, which is a critical requirement that can provide also a good return, for other business opportunities. And finally, again, if you have desks on EMA, start to work on your data vendor engagement strategy as soon as possible, because this will require a lot of time as well.
Excellent. Thank you. And thank you to all our speakers for sharing their expertise and experience. Thank you to Refinitiv and LSEG Business for sponsoring today's webinar. It's been a good conversation with a lot going on. Before we close, just a few 18 group items that may be of interest to you. If you scroll down your screen to additional options, you can sign up for our next webinar, which is this Thursday, and we'll cover how to optimize the business value of your data using agile data governance. You can download our latest regulatory data handbook, and that is quite a tome. And you can register for 18 Group's May Data Management Summit London, which will be live. I'm really looking forward to it. I hope I'll meet a lot of you there. That said, that's it for today. So thank you again to Fausto, Marco, Hani, and Santosh. And thank you to all of you who've taken part in the webinar. Please complete our feedback form, as we are always keen to hear your views and improve our products. Meantime, thanks again and goodbye.